Hello everyone, welcome to the series of Economics in 4 minutes. This is Dr. Atman Shah. In this video, I'm going to discuss the difference between revenue and capital expenditure. Kindly subscribe to our YouTube channel to find more videos on economics, SPPS and RStudio. Let's begin with the introduction. We know that budget is an annual financial statement of estimated receipts and expenditures of the government during a fiscal year. So we can have a budget of central government, state government, or local governments that shows the estimated receipts and expenditures. Now, the government budget comprises of revenue budget and capital budget. So you can see we have revenue expenditure and capital expenditure, and similarly we have revenue receipts and capital receipts. You can find our video on revenue receipts and capital receipts also. So let's start with the idea of revenue expenditure. Expenditure which neither creates assets nor reduce liability is known as revenue expenditure. For example, salaries of employees, interest payment on past debt, subsidies, pension. So this kind of expenditure do not create any asset or they do not reduce the liability. And these expenditures are financed out of revenue receipts. So revenue expenditure is the expenditure to run the government. These are associated with the expenses incurred for the normal functioning of the government. Let's understand the capital expenditure. Expenditure which either creates an asset or reduces liability is known as capital expenditure. So if government builds new hospital or school or airport or railway station, that creates asset. And if government repays the loan, that reduces the liability, and therefore they are known as capital expenditure. And these are financed out of capital receipts. So basically government spending on machinery, equipment, buildings, health facilities, education, roads, ports are known as government spending, and capital expenditure is more important than revenue expenditure because it creates assets and hence increases the production in the economy. That increases the GDP of the economy. And multiplier for capital expenditure is higher than the revenue expenditure. So if you are investing 100 rupees as capital expenditure, through multiplier, economy can have the GDP of more than 100 rupees. So if your capital expenditure multiplier is 2, then GDP will increase by 200 rupees. So that is the idea of capital and revenue expenditure. If you find this video useful, kindly like, share, and subscribe to our YouTube channel. Thank you.